Hello and welcome to the final video for Chapter 11. I'd like to start on page 1117 with you, and let's talk about corporate formation. All right. When you first start a company, all right, we learned that there's always something that you give up, and there's something that you always get. Now, normally when shareholders invest in their own company, all right, what they give up is going to be some kind of an asset. That could be, cash, or it could be property, plant, and equipment in exchange for the common stock of the company. Okay, so as the author points out on page 1117, a lot of times when shareholders give up assets, okay, they sometimes give up assets that have greatly appreciated in value. Okay, so for example, they had an office building maybe, or they had some equipment that they bought years ago, and in the case of the office building, the building could have appreciated in value. Okay, so when you contribute property that has appreciated, okay, you are going to realize, and here the correct term here is realize, a gain on the transfer of the property to the corporation. Okay, now there would be no gain if you transferred cash to the company, because there you're just exchanging cash for stock. The cash is not appreciated because cash is always recorded at its present value. Okay, but let's say, for example, you invest a building, okay, that has doubled in value. All right, you would have a gain on that exchange of the building for that stock. Okay, so the important things to remember here, we got a few terms here that we got to make sure we understand. The first term is realized. Okay, realized simply means that that the difference between what you got and what you gave up, if that answer is a positive, in other words, if what you got is greater than what you gave up, if that's a positive number, that is a realized gain. All right, that is a realized gain. All right, a recognized gain is a gain that you would have to report on your tax return. All right, now generally there is no recognized gain on the transfer of appreciated property to the company. Okay, but there are some exceptions. All right, especially if liabilities are being transferred in, or if the company is paying you an asset back to you, usually in the form of cash, and that's referred to as boot. All right, B-O-O-T. Okay, so let's take a look at the example that we have at the bottom of page 1117. Okay, we've got Robusta Corporation is formed by Max, who contributes property with a basis of $12,000 in exchange for 100% of the common stock of the company. All right, on the date of the contribution, the property has a fair market value of $120,000. Okay, all right, so and is subject to a liability of $20,000. So what is he giving up? Well, he's giving up a property that's worth $12,000. All right, okay. What is he getting? Well, he's getting stock that is worth $120,000. All right, plus he's being relieved of the liability of $20,000. Okay, well, the fair market value of the stock is not important here. What is important here is that he is giving up a liability of $20,000. That means that the company is assuming his liability. So it is as if the company had paid him $20,000 and then he turned around and paid off the debt on that building. All right, so he's getting 20, giving up 12. All right, so he has to recognize a gain of 8, okay, on the transfer of the liability of the corporation, which is in excess of his basis. Okay, that's the only amount that Max has to recognize. Okay, there's a formula at the top of page 1118, all right, that defines what the basis of the stock is when a person initially becomes a shareholder in a corporation. Okay, so let's take a look at that. All right, first of all, basis of the property transferred. All right, if it's cash, it's just the amount of the cash. If it's like a building or if it's property, it's what you paid for it plus any improvements minus any depreciation that you took before. Now, I'm not talking about normal depreciation. All right, you know, let's say you bought a car and it's depreciated in value. That's not what I'm talking about. All right, I'm talking about that if you had used it as a business asset before and had depreciated it. Okay, all right, so that's the basis of the property transferred in. Okay, less boot received. Again, a lot of times when people transfer in property, they're going to say, okay, I want common stock and cash in exchange. All right, any cash that was received is considered to be boot. Okay, all right, then you add back any gain recognized. Like Max had to recognize a gain of $8,000 because he transferred in a liability that was in excess of the basis of the property he was also transferring in. All right, less any liabilities transferred. So again, if you're transferring in a liability, all right, you're off the hook for that amount, so that reduces your basis in the stock. Okay, so that gives you your overall amounts. Okay, so just for example, look at the self-study problem at the bottom of page 1118. Okay, all right. It says Tammy has a business which she decides to incorporate. She transfers to the new corporation real estate with a basis of $75 and subject to a $34,000 mortgage in exchange for all of its stock. The stock is worth $125,000. Okay, so the question is, what is Tammy's realized gain? Right? Well, again, it's what she got minus what she gave up. All right, the real estate had a basis of $75 and it had a $34,000 mortgage. All right, now if she transfers in that mortgage to the company, she's off the hook for that mortgage. So that $34,000 has to be subtracted from that $75,000 basis, all right, to give her a new basis in that property of only $41,000. Okay, all right. So she's getting $125,000 worth of stock. She's giving up an asset, all right, her real estate that now has a basis of $41,000. So the answer to the first question, what is Tammy's realized gain, is $84,000. Okay, what is Tammy's recognized gain? All right, well, the mortgage did not exceed the basis of the real estate, so her recognized gain is $0. What is Tammy's basis in her stock? All right, her basis is the $75,000 real estate minus the $34,000 liability that was transferred in, so her basis is $41,000. All right, what is the corporation's basis in the real estate? All right, that's the $75,000 that was her basis in the real estate. All right, the corporation's basis is not affected by the liability. That is something totally different. The corporation's basis is strictly looking at the asset itself and not the liability that's attached to the asset. Okay, so for those of you that, you know, for example, someday might want to take the enrolled agent exam, all right, and by the way, Ivy Tech does have an enrolled agent certificate that you can earn. All right, if you are watching this video and you want some information on an enrolled agent certificate, just contact me and I will give you the specifics on it. Okay, so why do I mention that? Because there's an example on the middle of page 1118, all right, that involve three entities, probably individuals, A, B, and C, that form Hornbeam Corporation. All right, an example of an EA exam or a CPA exam question would be, they'll give you all of that paragraph of information up there, and then they give you 5 items. All right, what you could be tested on would be any one of those 5. So for example, if you read the example, the first thing that they want to know in number 1 underneath the example is, what is A's realized gain? So that would be like, again, that would be an EA exam or a CPA exam question. All right, and so you need to know the difference between realized gain, recognized gain. You need to know what basis is. All right, you need to know what shareholder basis is versus partnership, or in this case, corporate basis, because they're all different. All right, so if you read the data, all right, A contributes property with a basis of 25 in exchange for 40 shares of stock worth 40. All right, so what did he give up? He gave up 25. What did he get? 40. So he has a realized gain of 15, but he doesn't recognize any gain because he didn't receive any cash, or he didn't receive any assets other than the stock. Okay, all right. If you look at B performs services in exchange for stock worth $10,000. Okay, well, if you remember back in chapter 10, we had the Church and Dunn example. All right, and anytime you perform services in exchange for stock, you have to recognize 100% of the value of that stock as ordinary income on your tax return, and then your basis in the corporate stock is increased by the amount of gain that you would have to report. Okay, all right, let's look at C. C contributes property with a basis of $10,000 in exchange for 45 shares of stock worth $45,000 and $5,000 cash. All right, C's realized gain is 40. All right, but his recognized gain is only 5. All right, because the 5,000 is what C received in cash from the corporation. Okay, so again, there's a difference between realized gain and recognized gain. All right. So then we come back in number 4 to A. All right, what are the bases? All right, what are the bases? All right, well, A's basis in the stock is 25. B's basis in the stock is 10, and C's basis in the stock is $10,000. Okay, now the advantage of watching this video, I try to teach you or to talk to you a little bit about what's on the test. I'm not going to ask you any questions on the test involving 11-18. All right, you're going to need to know about the dividends received deduction. You're going to need to know how to compute the taxable income of a corporation, and you're going to need to know about Schedule M1 and how to compute, or how to fill out the M1. You're going to have to know how to do every line. All right, so take some practice in figuring out a Schedule M1, and that'll be the questions that are going to be on your next test from Chapter 11. There won't be any questions from this area, but like I said, for those of you that are looking ahead to maybe becoming an enrolled agent or becoming a CPA, all right, these are the type of items that you definitely need to study. Okay, that'll be the end of this video.